This is the Morning News with Bruce Kenyon on News Talk 770 Radio, Calgary's breaking news and conversation station.
We're joined now by Craig Burrows, co-founder and president and CEO of TriView Capital, here with our tax tip of the week, here to talk about RRSPs. Good morning, Craig.
Good morning, Bruce.
Okay, we have until the end of February to get them in, right?
Correct.
Okay. Is there any way for me, if I've lost the documentation, to go and find out how much I have, how much contribution room I have?
Yes, actually, it's pretty simple. You just have to go on to Revenue Canada site, or just look at your last tax report from the government, and they'll tell you exactly what you got left in your room for previous years as well as for 2016.
Okay, we're told time and time again that Canadians are not properly preparing for their retirement. Do you think the RRSP is the best route to go?
It's difficult to give a general to everybody. It really depends. There's multiple registered funds out there to use. If you have a certain age where you have kids in school, you obviously want to look at the registered education plan to that savings, to look at that to help for kids' education.
Right.
If you are close to obviously 70, you got to start getting out of your RSPs and going into RIFs. There's LIRAs for people who have been laid off and want to transfer money to LIRAs. But the one I think that people should be really looking at is TFSAs. To me, anytime the government gives you a tax-free savings, and the difference between the TFSA and the RSP is that you use today's dollars after tax to invest in something for a TFSA, where an RSP is you're deferring tax. So it really depends where you are as far as your income, what you're making, your time. TFSAs, to me, generally, if I had kids right now just starting into the workforce, I would pump into their head, bang in their head to start now, and put money in TFSAs. Because if you're a low income, you're starting a income job, TFSA is probably the best for young people versus RSP. Because if you're not making a lot of money, the return on the tax really isn't that much. Now, if you're someone who's close to retirement and you're seeing a significant drop in your income when you go to retirement, then of course the RSP is probably a better product for you.
Oh, okay. Now, it should be pointed out, though, and I know people have done this, they just put the money in the tax-free savings account. That doesn't make you a lot of money. You kind of have to invest it, don't you?
Well, yes. I can put my money in a RSP account and just sits there, but you have to be active. And January is a good time. To me, it's time. January is a good time to put down the donut and look at not only your physical but your financial health as far as going forward. And if you want to live a long time, you need to have money to do that. At least you want to live well. So, it's never too late to look at your portfolio and get help if you don't have it. Some people don't have that help. They try and go through the stocks. And the difficult thing is in the markets is I work all day and then to go home and try and put an investment plan. Unfortunately, as they say, most stats will tell you people will put more time into a 2-week holiday trying to plan for that than actually their retirement. So if it's overwhelming for you, some people are intimidated by investing, find someone that you can work with or you can trust, whether it's currently at your local bank, if you like the advisor there, or if you have a broker or a portfolio manager, you have more money. But even like TriView, we have multiple certified financial planners, which are the CFP designations, and they can sit down with you and give you a whole holistic plan. So if you can't do it yourself, find somebody that can sit down with you, take a look at the stocks and bonds, and of course, also what we do is the private equity side to make sure that you have a proper, well-balanced portfolio. And what's happening now with RSPs and registered funds, you can actually invest in private companies.
Okay. Typically, what do you think is a good, safe return on an annual basis? Would it be 5%? Would it be a little lower than that? Would it be higher? What should people kind of hope for?
I think realistically in the public markets and seg funds, if you're getting 5%, that's kind of the target you need to look at. It's pretty hard to get over a 5% over that. I mean, this year, if you look at the market, it was up 15%. But if you look over the last 4 years, it still isn't where it was back in 2014 at its high. So you still could have lost money. If you're looking for yield, 5% is pretty much a fair number to look at, yield return. People use private equity as a little piece of their portfolio to try and get a higher number. In private equity, you're looking at 8-10% return. So when you put those two together, you're looking at a 6 to 7. And if you can get 6 to 7% overall portfolio, you're doing pretty good.
I would think so. And beware the guy who's kind of telling you he can get you 15%, right?
No, but you have to assess the risk.
Yeah.
The the higher the return, the higher the risk generally. And but that being said, I've seen many opportunities come across my desk where they're low yield and high risk. And you also got to be sure that just because it's a low return, don't assume that means low risk.
Just okay. Well, all right. What? Go by that. Give me that again. Just because it's a low return, just don't necessarily think it's a low risk?
Yeah, you'll see some investments that could say 4 or 5%. I'm looking at like private, even public. The volatility in the stock market. It's the trick, Bruce, really is it's a 4-letter word. It's called time. And how you make money, you put your money aside, you start early, and you just slowly work. You don't try and hit home runs. You don't try and triple your money. That's casino. That's high risk. But that being said, there are some returns I've seen companies offering 5 or 6 or 7% return, but when you look at the risk matrix, it's so risky that the chance of losing money is very high. So you got to make sure that just because it's a low return, make sure the risk is low as well.
Okay, good advice, Craig. We'll talk to you next week. Thank you very much.
Okay, take care, Bruce.
Craig Burrows, he's the co-founder and president and CEO of TriView Capital Limited. I mean, the long and the short of all that is it's probably a good idea to get some advice as to what is good for you.
The Morning News, weekdays starting at 5:30 a.m. on News Talk 770 Calgary.